The mention of the year 2008 rings a harsh-pitched bell for most Americans, and even for others, as it was a terribly uncertain time for millions of people. We were in the middle of a stock and housing market crash, and no one was sure what would happen. The market would eventually end its correction around 50% down from its all-time highs in March of 2009, with the biggest one-day market drop in American history up to this point occurring on September 28, 2008, where the Dow Jones Index fell by over 750 points, right around 7%. Why does this matter? Because this is the backdrop for what could be one of the biggest commodity manipulations of all time. The current scenario focuses on three fellows who work at JP Morgan and Chase as precious metals investors, who mainly focused on gold and silver, but may have dabbled their hands in others as well. Michael Nowick graduated Duke in 1996 and went straight to work at the firm. He had early success and eventually made his way up to the head of base of precious metals. Greg Smith was a senior lead operations specialist, and Jeffrey Rufo was an executive director who specialized in sales, but both were involved with gold trading. These three men are currently on trial for the accusation and manipulation of the precious metals markets from 2008 to 2016. It is interesting that this is a racketeering case, or RICO, but the three guys face a combined of 25 plus charges ranging anywhere from the racketeering and wire fraud to the spoofing and manipulation of the market. All of these charges carry heavy sentences, with someone already being sent to prison for 3 years for spoofing, and you can face up to 20 years in prison for racketeering charges. But it is yet unsure just how far and deep this hold goes. The time the accusations took place were from 2008 to 2016, so it is clear that the U.S. Justice Department has been working on this case for a while, and it could be their most aggressive case to date, targeting the manipulative trading tactic known as spoofing. So, what is spoofing? The ins and outs of this illegal tactic can be very complex and possibly even theoretical, so it is best to keep it simple. Spoofing is when one buyer places an open bid on a particular stock, bond, crypto, or in this case, a commodity. Now normally, another investor would come along to sell their gold to the buyer, but instead, before the order can be filled, the original investor cancels it and removes it from the bidding, and both walk away with nothing. This is obviously different from placing an order that does not fill and then having to reorder it at a different price. These investors, from the start, never had the intention of buying the commodity. And it may not seem like a big deal, but we should know that spoofing was outlawed in 2010 when Congress passed the Dodd-Frank Act after the financial crisis. Now you may be wondering, why spoof if the original investor walks away with no gains or losses? Well, in this story, this is probably how it went. The three investors owned plenty of gold and silver, but instead of adding to it naturally and legally, they decided to try a different tactic. Instead, they chose to place bids on orders well above the current price. Volume is a huge factor in stocks and commodities, so I'm talking about a lot of bids here. Next, they canceled them before they were filled. This could make the market and other investors think that the demand and price were both increasing and that they should buy in, when in reality, nothing is happening. So worst case for our original investors, whatever the commodity was going to do, it does. Or the best case, their false purchases cause other investors to jump in, which would increase the value and return of Michael's, Greg's, and Jeffrey's commodities that they own. Now this was not an issue for a long time on the stock market. However, in recent decades, with the invention and improvement of high-frequency trading and advanced algorithms, the tactic blossomed, especially since it was so hard to prove. It was even stated that some trades had been flagged back in 2014 by an internal surveillance system, but JP Morgan took no actions against it. Now that we know the story, I put together some information to see if we could try to figure anything out for ourselves. I eventually wanted to try to find JP Morgan and Chase's financial history in their precious metals division, but trying to find this information accurately proved to be difficult enough. So what I did was take a look at some of the biggest financial institutions in America and see how their net income changed from 2005 through 2016. Comparing Goldman Sachs, Morgan Stanley, Bank of America, and Citigroup to JP Morgan might give us a glimpse at some illegal activities. Here are a few things that I noticed. You will see JP Morgan listed at the bottom, and I also uploaded a chart of the Dow Jones Index so that we can see how the overall market is looking at this time. When looking at JP Morgan's numbers, we can see that they were the only firm to have over 50% returns in both 2005 and 2006, which was allegedly before the time that the illegal activity began. They managed to stay positive through the beginning of the crash in 2007 and have a decrease of 64% in net income in 2008. However, this is the second best return on the list for that year. Then, in 2009 and 2010, JP Morgan does what no other company can find a way to do. They increased their net income in both years. We see on the Dow chart that by this time the overall market is rebounding, yet only one of the financial firms could increase income in both years. I wonder if their control of the commodities market played a role in this. On the spreadsheet, I highlighted yearly gains of 50% or higher in green, and we can see that JP Morgan has 5, which is tied with Bank of America for the most. In red are yearly income drops of around 40% or more, and JP Morgan has the least of these years, with it happening in 2008 and 2011. It is interesting that their income seems to be a little less volatile than the other financial institutions. Finally, I had one more idea. I decided to take the average net income of each company from 2005 and 2006 and check to see when the company was able to post 2 yearly net incomes higher than this. I figured this would be a decent way to see the strength of each company as they embraced a harsh bear market. Goldman Sachs seemed to fare the storm as well as JP Morgan, who both had successfully hit the income markers by 2009. They were actually both able to stay above their marker again in 2010. However, JP Morgan rose almost 50% from 2009, where Goldman Sachs fell 40%. But the same cannot be said for the others. It took Morgan Stanley until 2018 to hit the markers, and Bank of America didn't do it until the next year. And rest in peace to Citigroup, who has yet to make it back to their average net income of over $23 billion. Here are some extra points to the story. The lawyers defending the investors have said that the data and the reasoning behind their orders has been misconstrued. But what good lawyer wouldn't? Here's the statement from the firm's co-president, Daniel Pinto. The conduct of the individuals referenced in today's resolutions is unacceptable and they are no longer with the firm. He also added that the bank had invested considerable resources in boosting its internal compliance policies, surveillance systems, and training programs. Well, that sounds reasonable enough to me. Back in 2017, the Justice Department began using techniques it originally developed to spot healthcare fraud schemes to identify suspicious trading patterns, including by scanning activity on stock exchanges. We will see if they uncovered anything after 2016. These final points are some things that stuck out to me that may be concerning. JP Morgan has already agreed back in 2020 to pay more than $920 million and admitted to wrongdoing to settle with the Justice Department and the Commodity Futures Trading Commission over the conduct of the traders who have pleaded guilty and are facing trial. If a company openly admits a crime and to pay a fine, that doesn't look good for the accused. The Justice Department has already charged 6 JP Morgan traders for manipulating metals futures between 2008 and 2016, the same time period as this one. Then, last Friday, 2 former Deutsche Bank traders were found guilty here by the federal jury of spoofing, one of the main charges that these guys face today. JP Morgan has had one of the largest precious metals holdings on the market for the past couple of decades. So this manipulation tactic could very well be possible. In parallel settlements, the bank entered into a deferred prosecution agreement with the Department of Justice and the United States Attorney's Office for the District of Connecticut, staving off criminal prosecution on charges of wire fraud. Unfortunately, it appears as though JP Morgan & Chase is very familiar with illegal activities, and that spoofing is a concern for many firms. Hopefully this trial will reveal some more details on just how drastic this commodities market manipulation really was. And now you know. Thank you everyone for watching. I hope you enjoyed it and maybe even learned something new. Y'all have a good day and I'll see you next time.